And with that, we're just going to keep things rolling. We have the honor and pleasure this year of having Mr. Milton Berg with us. Milton was scheduled to be a presenter at our 2020 symposium that, of course, had to be postponed due to the pandemic. But he's had an incredible career on the buy side. This gentleman has used technical tools and processes throughout some of the biggest hedge fund titans in the industry in terms of advising their process after Milton himself won Lipper Awards in '87, managing mutual funds through a very volatile period. And we are very excited to learn from you, Milton, about your current macro views, but also your process and tools as technical analysis comes into play. I know you are a CFA charter holder. But Milton reached out to me just recently and said, you know, I really need to be a member of the CMT Association as well. And we are glad to have you, sir. You also have been a great advocate for the discipline, and we welcome you here this morning. We've got a couple things to point out to the audience. If you are online, you can see the little handouts section for your GoToWebinar meeting. There are a couple of pieces in there that Milton sent to us ahead of time. Those are also available in the digital app, the event guide for the conference. And we are really pleased to have Milton with us, but also he's been very generous in sharing his research and tools. And Milton, looks great. We can see your slides.
Great.
And welcome. How are you this morning?
Good. Can you hear me well?
We can hear you loud and clear, sir.
Okay. Good.
And with that, I'll get out of your way and we'll let you take us through your process and through your charts. Thank you, Milton.
My name is Milton Berg. I've been in the business since 1978. I originally started as a straight fundamental analyst. But over the years, I realized that the true edge is on the technicals. I developed my own sort of technical analysis. It won't necessarily be in line with the kind of technical analysis most people use, and I will try to use this presentation to give the audience some idea as to the type of technical work we do and exactly how this helps in the markets. First of all, I want to state what we've done over the last year as far as our research. Since April of 2020, our model-based signals were generated 103 times. In other words, we have 103 distinct buy signals generated for the S&P 500 and other equity markets in the United States since April 2020. These 103 signals represent 622 historic instances in the market where the same indicators signaled. So we have signals currently based on what happened in the past, 103 signals based on 622 historic instances. And as you can see, the arrows represent the signals we received. We list the numbers. And we actually got a sell signal on April 8th, which we will discuss later on in this presentation. But throughout the year, we had buy signals. As a broad market view, based on the buy signals, the market can go significantly higher. Based on the signals we got in April, the minimum expectation for the S&P is 4723.77. This table shows what, not only do we get buy signals, we actually get market projections. So for example, in October 2020, we had 5 signals based on 31 historical instances, which projected a median minimum level in the S&P 500 of 3663.94, which we attained. It projected a median level based on the historical signals of 4321, which we have not yet attained. It's 3.3% above current levels. Whatever you see in yellow has been attained already. So the median projections from April through September has been attained. The September signal projected 4183.41. We're currently at 4194 in the S&P. The next page basically shows what percentage increase in the S&P was projected. So for example, in April, the signals we generated in April projected a minimum 21% gain in the S&P, a median gain of 42%. The signals in April 2021 projected a minimum 19% and a median 33%, which seems quite high, but this is what our data is telling us. In this presentation, I will try to show you how we get this data, how our technical work is different than a typical type of technical analysis most technicians use. And we're going to show how disciplined and data-based our work is, as opposed to based on on headlines, opinions, feelings, and so on. But this is a very important table we give our clients because we tell our clients where we expect the market to go. Besides being on a buy signal since February 2021, we expect the minimum S&P within the next 12 months of 45.77, median of 47.61. That's just reviewing that type of situation. The next page is also something our clients see because they actually see our signals. And for example, April 27, 2020, we got a buy signal, signal number 151, and that had 6 historical instances. And just as an example, what was the signal? What went into the signal? Number 1, the S&P 500 had declined 15% off its latest high. Number 2, it held its low for 8 days. In other words, the stock market stopped going down and it held its low for 8 days. It made its low 8 days ago. And we had the first VXN deviation signal after a low. Now, what is a VXN deviation signal? Basically, as I will point out in this presentation, we look for concentrated signals. 1, 2, 3, 5, 10 days. We don't look at 200-day moving averages. We don't look at 50-day moving averages general. We're looking for concentrated signals. We take the VXN, which is the VIX on the NASDAQ, and we look at it. I'm not going to give you away our secrets, our sauce, but let's assume we look for 10 days over 50 days. We look for how is VXN traded over the last 10 days relative to the last 50 days? We're going to look for a sharp decline in VXN relative to its 50-day average. That gives a signal. So if the market's down 15%, held for 8 days, and we get on that 8th day, we get the first VXN deviation after the low, that is a buy signal. The second one is in the buy signal, the 10th is in the buy signal, the third is in the buy signal. We want to be a signal 8 days after the low, it must be the first signal. And it happened 6 times in history. As you can see, we've gained 45.48%. We're way above the projections. This goes back in April. Let's go to the next page. So let's actually go now to June. On June 3rd, we got a signal which had 16 historical parameters. Now we're going to elaborate on this later on in the presentation. I just want to do this sort of as a review. We track the S&P equal weight index. Now we have a unique S&P equal weighted index because the one you see on Bloomberg is rebalanced once a month. So that's equal weighted 12 times a year because since it's only equal weighted once a month, the gains or the losses of the first day already offset the fact that it's equally weighted. We have a daily equally weighted S&P 500 index, or you can call it an unweighted S&P 500 index. And we have what we call a deviation trend thrust. We're also looking for a movement over a very short term over a movement. This is momentum over a longer term. It's a momentum indicator, but let's, for example, use 10 days over 50 days. We want to see how has the S&P 500 acted over 10 days relative to its 50 days. And when you get it above a certain threshold, that's a deviation trend thrust. That signal on June 3rd, we have 16 historical signals. That projected a minimum of 3302 within 12 months, a median of 4,093. We went 2.31% above our median projection, not quite 12 months yet, but this signal is working. And we're going to elaborate a little bit how these signals work. I just want to give you a background as to what our clients see. Signal 186, July 6th. July 6th, the Dow had declined 9% over its latest high and generated its latest low 4 to 7 days ago. The 4 to 7 day level, we learned that from William O'Neill, but we've sort of taken many steps further within our research. We now do day counts, day 1, day 2, day 3, day 4, up to day 10. And we look historically, what has the market done 8 days after a low, 10 days after a low, 6 days after a low, and so on. This particular indicator says the Dow declined 9%. There was a correction in June, so the Dow declined 9%. It bottomed 4 to 7 days ago. Within 4 to 7 days of the low, the Dow gained 1%. But at that same day, the S&P 500 generated a 5-day breadth thrust of greater than 2.9 to 1. That projected a minimum of 35.92 based on the 5 instances, a median of 43.56. We haven't hit that yet. That's 4.13% above current levels. We had signals again in September 28th, after the correction in the NASDAQ. S&P generated a single 14 to 1 upside issue day, day 3 after a 9% decline in the index. So we're counting day 3. How many times in the past has the S&P generated a 14 to 1 upside issue day, 3 days after a decline of a minimum of 9%? That has taken place 6 times in the past. We're filtering for 5-day volume because 5-day volume after a decline is a very bullish indicator. We did not get the 5-day volume in this case, the increase in 5-day volume. So we're filtering, we're only going to look at cases where there is no increase in 5-day volume above a certain threshold and see whether you have bullish indications. What we did, the minimum projection was 39.39. The median was 42.35, which is 1.25% above current levels. So this is what, again, what we do for our clients is, what we do for ourselves is we analyze markets, we look at historical precedents, and we make projections based on what has the market done in the past after these specific historical precedents. Let's get a little closer now to the current period. November was a great month for signals. November 10th, the S&P declined more than 7%, generated low 7 days ago. NASDAQ had a 7-day AD thrust of 1.5221, and the Russell gained 1.5% on that day, day 7 off a low. Same story, which projects to a minimum of 38.97. I don't think I want to take too much time showing these tables. Let's just go to where we are now. Let's go to where we are in March and April. On March 15th, signal 255, NASDAQ had a 10% correction and stopped declining 4 to 7 days prior. And within 4 to 7 days of a NASDAQ decline of greater than 10%, believe it or not, more than 93% of stocks in a broad index, this is a broad index of 1,700 stocks we've created, 93% of those stocks trade above their 10-day. We're not looking at 200-day, we're not looking at 50-day, we're looking at concentrated movements. So 92% of stocks were above the 10-day moving average 4 to 7 days after a 10% decline in NASDAQ. Very, very rare to see that, but historically it's happened 3 times. And historically, the minimum projection was to 48.52, which is 16% above current levels within 12 months. It's a very potent type signal, although it's only 3 historical instances. Very rare to get a 93% stocks above the 10-day moving average within 7 days of a 10% correction in NASDAQ. The median projection is 49.41, which is 18 points. Now, what we do is, when we look at our monthly signals, and then we get the median of all these signals. So 49.41 is very high level, but if you look at the median of all the median projections, the median for the March projections is 48.68, which is 16% above the current level. And let's just see what we have in April. In April, we had quite a number of signals on April 1st. For example, we had a 1-day momentum signal, and it goes as follows. S&P was up on the day on lower volume. S&P 500 made a new minimum of a 6-month high. S&P 400 on that day, where the S&P makes a 6-month high, the S&P 400 was up 1.25%. NASDAQ was up 1.25%. Russell 2000 was up 1.5% or greater, and the S&P small cap was up 1.5% or greater. In the past, how many times have you seen the S&P close at the minimum of a 6-month high and have so many averages trading greater than 1.25% in the day? It happened 6 times historically, and those 6 times project to a minimum of 4488.35, which is 7%. So that's one of our April signals. Another April signal is the Russell, April 1st, Russell declined 9%. It bottomed 6 days ago. And 6 days after a decline of 9% of the Russell, the S&P generates more than 50 new highs. Also kind of strange to see more than 50 new highs 6 days after a 9% correction in the Russell. But that has happened 6 times in the past, and that projects to 45.08 as a minimum, 49.89 as a median. And the last one for it would be Russell gained 1.10% in 5 out of 6 days. And on the 5th day of the signal, Russell was up 1.5%. In other words, in the last of the 5 days where the Russell was up 1.10%, it was up a minimum of 1.5%. This too is a momentum indicator. This happened 5 times in the past. And this projects to 5,076 within 12 months based on its history. I give you what my clients see as far as table form. Let's sort of like get into our theory of technical analysis. The theory of technical analysis we use is very similar to Joe Granville's theory, which was the technical analysis in the market. If it's obvious, it's obviously wrong. We've refined that a little bit. We say if it's obvious, market movement will be random as opposed to predictable. So it's not, we can't use it as a contrary indicator saying if it's obvious, obviously wrong, and the market will do the opposite of what you say it will use. We find that if it's obvious, the market movement will be random. If you want to get a movement that is predictable, it's not random, you have to use things that are not obvious. I'm going to give you examples of things that have been obvious, that some technicians have been referring to, some fundamentals have been referring to, which just haven't worked. I went back to November 2017. We saw a record high in margin debt as a percentage of GDP. What the pundits were saying was, well, in the second quarter of 2000, we saw a record of margin debt relative to GDP, and the market had a 90% correction, 90% bear market in NASDAQ, 50% in the S&P. Third quarter 2007 led to a 59% decline in Russell, 50% in the S&P. So this record high is also telling you the market's going to crash. The reality was we're now more than 3 years later, NASDAQ's up 123%, Russell's up 57%, S&P's up 61%. If it's obvious, it's obviously wrong. If someone could just see a chart, the margin debt versus GDP, and say the market's going to go down, it's not going to work, or at least that it's just what's going to happen with the market is not predictable. The market may go down, but it's not predictable. Same thing over here. Record low mutual fund cash assets November 2017, as you can see. There was a record low in August 2000, led to a 80% decline in NASDAQ, 50% decline in the S&P. April 2006 was early, but it did lead to the 2007, 2008, 9 decline in the S&P of over 50%. So pundits were saying, well, October 2017 is the lowest in history. Of course, the market's going to crash. NDX up 123% since then, S&P up 61%. If it's obvious, if it's easy, it's just a simple chart, you can say that the movements will be random and not predictable. So too, stock market sentiment. University of Michigan, survey of consumers, probability of an increase in stock markets for the next year. We hit a record in July 2007. Wow, that was just when the Russell peaked, 2 months before the S&P peaked and the NASDAQ peaked, which led to a 50% decline in the S&P. Well, you had a record then, you have a record October 2017. Of course, the market's going to tank. Same story, S&P up 65%, mid caps up 50%, Russell up 56%, NDX up 134%. If it's obvious, the movement ahead will be random, not predictable. Now, this is a fasting indicator, which also didn't work. National Association of Active Investment Managers track their members. The most bearish investors' allocation to stocks was 90% long. In other words, the typical investor was leveraged long. The most bearish investor in their survey was 90% long. Wow, what an extreme in sentiment. It's even above the 50% you saw in late 2006, which led to the 2007 Great Bear Market. But guess what? If it's obvious, it's obviously wrong. But there's more to it. It's also, none of this is market-based, you see? What we try to do is create technical indicators that are truly technical indicators, that are based on the body of the market, based on the market action itself. Just like a heart surgeon or a cardiologist wants to find what your heart is doing, he takes the EKG, but the EKG data is based on what the body is telling it. It's based on the heartbeat, based on the pulse rate, and so on. Not based on the person's diet. EKG tells you the diet is not going to, there are people who eat fatty foods and don't get heart attacks, and I use that as an example. We try to use market-based data exclusively because that's what works. Another example is this. This is a famous cyclically adjusted price-earnings ratio, which is supposed to call the market top. You see, it had a peak in 1929, led to the greatest decline in the history of the market. Had a peak in 2000, led it to the greatest decline in the history of the NASDAQ. Had another above those two levels, November 3rd, 2017, which would suggest on a valuation basis, hey, the market's got a tank. Same story, S&P up 61%, NASDAQ up, NDX up 123%. The market is not a machine where you can just see what happened in the past in valuation and project to the future. The market is not just a machine where you can see what sentiment was in the past and project what's going to happen to the future. But the market does, in our opinion, generate aberrations at turning points. And we'll get to that in a moment, but let's talk about one of the great technicians in the history of the market was Benjamin Graham. Benjamin Graham used value as a technical tool. He found when stocks are overvalued, generally if you shorted a basket of low-valued stocks, you'd be able to cover that short at lower levels. And he found if you bought a basket of stocks that are undervalued, eventually you'll be able to sell those stocks at higher levels. It's pure technical analysis using value as a technical indicator. And it's worked pretty well, not perfectly well, as we know, because value broke out of Graham's parameters in the early 1960s, and he had to redo his parameters. But he also made a statement in Columbia Business School. He made a statement in 1946 that based on history, the Dow Jones will never generate a permanent breakout. What does that mean? It will never generate a permanent breakout. What he said was every bull market peak will be followed by a decline below that peak at the next bear market, not the first bear market, at the second bear market. For example, the Dow peaked in 1906, had a bear market, had another peak in 1909. The decline in the 1909 bear market took it below the peak of 1906. So too in 1917, the Dow had a peak, had a bear market into 1918, had a new high in 1920, and the decline to 1920 took it below the peak. You see, 1929 peak, bear market took you below the peak of 1922. The 1937 peak took you below the peak of 1934. And that was Benjamin Graham's theory of technical analysis in projecting market action. However, Benjamin Graham obviously was wrong. Post 1946, look at these peaks you saw in 1960 to 1976, 1974. And the breakout was a permanent breakout. The next bear market did not take you below these peaks. Look at the 87 peak. The next bear market did not take you below the 87 peak, and so on and so forth. So the reality is the market is not a machine where you can just look at previous price history and project it to the future. Markets change. Now, people didn't believe me when I said markets change, so I had to create a study to prove that markets change, and this is the study. We looked at the Dow Jones Industrial Average from 1900 to 1950, and we calculated its daily mean return, its standard deviation of daily return, its skewness, and its kurtosis. The mean return for the Dow Jones for the 50 years from 1900 to 1950 is 0.2%, 0.02% per day. Standard deviation is 1.21%. The skew is 0.15, and the kurtosis is 15.79. Now, this is a 50-year period. This chart, we did 10,000 random simulations, but the chart only can show 100 because we show 10,000, you'll have a red chart, will be totally red. But we'd actually calculated 10,000 random walks using these statistics. Now, of course, the Dow from 1900 to 1950 is smack in the middle of what would be expected using statistics. Obviously, this Dow generating these statistics, generating random, ultimately half will be above, half will be below. That's how randomness works. But then we took the same statistics in the Dow, mean 0.2%, 0.02, standard deviation 1.21%, skew 0.15, kurtosis 15.79, and we projected what would the Dow do in the future. Well, the red is the random movement. Again, there were 10,000 random movements. The Dow outperformed 9,989 of 10,000 simulations, which tells you that the Dow from 1950 to 2015 is not the same Dow as 1900 to 1950, which goes contrary, it seems, to technical analysis, because technical analysis is using past market fluctuations to somehow project future market fluctuations, and it just doesn't work. Let's look at the S&P. We did the same thing. S&P begins in 1928. Took the S&P from 1928 to 1950. These are the list of its statistics. We calculated 10,000 random walks using these statistics in the future, and we found that in this case a little bit better. The S&P outperformed 9,946. So there were actually 54 random simulations that outperformed the S&P. But this shouldn't happen. This should not happen if markets are unchanging. This would only happen. And the statisticians who calculated this to me were amazed. They truthfully couldn't believe it, but you have to believe it. Markets don't change. Markets change. However, although markets change, and this we make a point of this in our research we wrote for the CMT in the boundaries of technical analysis, although markets change, because markets generally are random or not predictable, they are predictable when you look at the market in a concentrated way. You look at short-term data. Short-term data tells you what the long-term will be. Long-term average over 50 years will not give you any clue as to what the future will be. Let me give you one example of short-term data, which was an amazing predictor of the future. We calculated the trend in the New York Stock Exchange going back to the early 1900s, and we saw there was only one day in history where trend was above 12.75. That was on January 8, 1988. Trend was 15.50. Well, I remember that day clearly, because that was a little bit after the crash. We turned bullish after the crash. On that day, S&P declined 6.77%, and trend closed at a record 15.50. And myself, oh no, here we go again. The crash is beginning. The bear market rally right here has ended on January 7th. We're headed right back down to lower lows. That's what people thought. But the trend at 1550 told you something differently. The reality is that that 3,086 days after that trend, you got your first bear market. It was the top of the before the next bear market, down 30%. You gained 527% in 3,086 days. That was the greatest gain over a 3,086-day period in the history of the stock market. Now, you can't project what the market will do over the next 3,086 days. You can't project that. But you can say that you get an extraordinary high trend of 15.50 after you're getting bullish indicated after market crash that the market returns will be extraordinary. And they were extraordinary. 47% gain before the next 10% correction, 52% gain before the next 12% correction, 527% gain before the next bear market, and the greatest gain over a 3,086-day period in history. So it's a short-term movement. It's a one-day trend that gives you a clue what will happen over the long term. It's not a 50-day moving average or a 200-day moving average or a crossing or a breakout of an indicator. It's something strange and aberration that takes place over a short term. Now, we all know Paul Montgomery was a member of CMT. He was one of the greatest, the late Paul Montgomery is one of the greatest analysts, market analysts and tech analysts in the history of our profession. And I worked very closely with him. And he used to have these, what they call cycle dates. I worked very closely with him. He didn't disclose all the cycle dates, but I disclose some of them that he didn't disclose. And we give our clients every year a list of what the cycle dates will be for the full year. So we have 2018, 19, 20, 21. What is the cycle date? We're not going to get into it now, but the cycle turn dates, the days that suggest the market will turn. They're not 18-year cycles. They're not time-based cycles at all. They're cycles based on things that have been proven to affect the emotional status of human beings. Let's put it that way, because ultimately the market moves based on emotions and sentiment. If someone sells, it's because his mind tells him to sell. Or his emotions tell him to sell, and someone buys it because his mind tells him to buy, or the emotions tell him to buy. At turning points, there's a turn in these emotions, or there's a turn in the willingness to buy or sell, and that's what generates turning points. So, for example, let's look at the S&P 500 based on these cycle dates we mentioned. The S&P peaked on January 30th, the S&P on January 30th, 2018, just at a 10% correction. It was a cycle date. It gapped down on the cycle date, which led to the 10% correction. And then the market in June 28th, 2018, June 13th was a cycle date. The market topped off its previous low. It only declined 3.13% to its net cycle date, but then it gained 8.37% to the September 21st, 2018 WGN cycle date, which is one of the Montgomery dates. That was the peak for the S&P 500 before the 19.78% decline into its next cycle date on December 22nd, 2018, which marked the bottom of the market. We got aggressively long that day because of this cycle and because of the technical indicators we've seen. Market gained 25.29% off that cycle, not into another cycle, but on June 3rd, 2019, the market bottomed on a cycle date and gained 10.25% over a very short-term period and ultimately made a new high in 2020. We had a cycle date on June 8th, 2020, led to a 7% decline in the S&P and an 11% decline in the Russell. And the last major cycle date that had an effect on the market was October 30th, 2020, which was the day that the S&P had a correction closed slightly above its September low. And from there, the S&P gained 28% to its latest high. Cycle dates, cycle turn dates. They're not obvious and they're not believable. People don't believe these can work. And that is precisely why they work, because there's a reason for them to work, because they affect the human psyche. And due to the fact that no analyst in his right mind will trade based on cycles, and that's the reason why these cycles happen to work, because it is not obvious, but it makes sense, and therefore historically it works, and it's going to work in the future. Let's take another cycle. Bitcoin has no intrinsic value. Bitcoin, in some analysts' opinion, including mine, is basically it trades strictly on psychology and sentiment. It's an asset with zero intrinsic value that trades because people believe it has some value. And there's nothing wrong with that, because all markets trade on sentiment and psychology. So Bitcoin has a 0% intrinsic value. It's trading at $55,000 a coin, strictly on sentiment and psychology. But things that trade strictly on sentiment and psychology theoretically should be more affected by cycles than the S&P, which trades on fundamentals as well, and valuation as well, and that is true. Bitcoin is a prime candidate for cycle dates. Bitcoin peaked at a climax top. It wasn't a cycle date, December 18, 2017, but Bitcoin declined 70% and made its low into a cycle date. The cycle date was on June 29th, cycle was on June 29th, 2018. It gained 44% off, 40% off that cycle to the next cycle date in July 25th. It then declined 61% to the next cycle date on December 7th, 2018. Gained 43% in just 2 weeks to the next cycle date, December 24th. So Bitcoin trades on these Montgomery cycles. We just had a Montgomery cycle on April 27th, where the Bitcoin declined 27.43% in a matter of 10 days. And at bottom of that cycle date, so far has gained 19.93% off the cycle. So cycles work in equity markets and capital markets, certainly works in Bitcoin and gold. You have to have the right understanding that not every cycle is going to turn a market, but cycles will turn markets, and you have to combine cycles with measures of sentiment, measures of valuation, and measures of belief or disbelief in a market move. This is a very important chart on the next page, a true random walk. I showed you my previous study where I did 10,000 random walks in the S&P 500 and in the Dow. This is one single random walk. The red is one single random walk in the S&P. The blue is the actual S&P. I chose a random walk that began and ended at the same time. Of course, it began in 28, but it's sort of the return over the 70-year period was, over nearly a 90-year period. The return was pretty much the same. So, but there's one thing lacking in the randomness that you find in the real S&P, and this is the key to what we do. And I'm showing you a large chart, but we did this on a short-term basis as well, blowing this up. On a real basis, you had 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 spike bottoms in the S&P. Spike bottoms. You only had one spike bottom in this random walk. That's sort of over here. It's arguably a spike bottom right here. Markets spike not because of valuations, and markets do not spike because of growth. Markets do not spike because of the Fed. Markets spike on the downside and make a low because of a reversal in sentiment. Sentiment to the downside, where people say, let me out, and then back to the upside where there's no one left to sell and people are short, say, get me in. That did not happen on a random basis. Even using the same statistics, 0.03 standard deviation returns on a daily basis, 1.15 skew, so on and so forth, the randomness did not show spikes. It showed rounded bottoms and rounded tops. Real markets in equities show spike bottoms, sometimes show rounded tops, often show spike tops. In commodities, you most often see spike tops and rounded bottoms. But in any event, this is it. This is the key to what we do. We're looking for those spikes in sentiment, not necessarily spikes in price action, but spikes in extreme sentiments which suggest a turn in the market, either to the upside or the downside. People are talking about, this is one spike I'd like to talk about, which is a spike in the 6-month rate of change of Treasury, of the 10-year Treasury note. Originally, I was told I had to speak about interest rates. I'm glad I didn't have to, but I will show this chart. Historically, there's only been 2 times in the past where the 6-month rate of change of the 10-year Treasury bond has been greater than 40%. I track it here against the bond. Let's track it against stocks. 2016, it gained 20% over the next 12 months. 2009 gained 32% within the next 12 months. Currently, you had the rate of change like January 31st. We've gained 10.51% in 2 months. So historically, spikes in interest rates are bullish for stocks. So all the pundits were saying the Treasury bond is up, yields are up. Statistics told us this is the kind of spike that suggests a further up move in the stock market. These are the statistics I'm going through that the clients see. Historically, there's a 26.41% median return, and that goes into the tables we show. We show the Treasury bonds buy signal. We say based on the 2 historical instances, we expect a median return of 26.41%, a minimum return of 20.41%, which is the 2016 instance. Now we're going to go through. These are the charts of the historical cases where the Treasury bonds signaled and how the market acted. Now we're going to go through some of our indicators. I think I still have some time left. We'll go through our indicators and show you precisely what we've shown our clients, what we do, and you yourselves, members of CMT, will see whether this is in line with the typical technical analysis, or maybe this is sort of a different cut of technical analysis. It's a little bit different. Now, of course, some of the stuff we do is conventional, but a lot of the stuff we do is totally non-conventional. but it is pure technical analysis. Pure, meaning it's using exaggerated action in various technical indicators, and it's used to call precise market moves either to the upside. Here we're going to talk to the upside because according to the bull market, that seems to not have ended at this point. April 27, 2020, buy signal number 151. S&P declined 15% off its latest high. It held its low for 8 days. We're counting 8 days off a low. First VXN deviation signal after low. We mentioned this earlier, where the short-term movement of the VXN, the VIX and the NASDAQ relative to its longer-term movement showed a sharp decline below a threshold. Compact action. This has happened in the past 7 times. And let's see what the markets did. Look at 7 times. Gained 30% within 12 months, 27, 34, 28, 20, 24, median 27. That's how we get the median return of 27% for this indicator. The minimum was 20.31%. That's how we get the minimum. And then we median and minimum out for the full month's indicators to give a full month projection. Let's get another signal. Another signal. S&P generated a 30-day high. No big deal. You know, we're now at the all-time high. But S&P generated a 30-day high, but not one single stock in the S&P 500 generated a 60-day low. And at that same time, the New York Stock Exchange showed a 5-day rate of change of 6.5%. So again, we're looking at compact, and we say 30-day high. We're not looking over a 30-day average. We're looking at today on one single day, the S&P is making a 30-day high. We're looking today on one single day. Not one stock is generating a 60-day low. This is not the same as a 30-day average or a 60-day average. As you say, we're looking for concentrated indicators to suggest turning points. Now we're looking at, we are using a 5-day gain in the New York Stock Exchange. We're using 5 days. So there's been 10 signals in the past. The median return has been 31%. We've gained 40.89%. This is a table the client gets. Let's go to the next signal. Buy indicator number 164, May 27th, 2020. S&P 400 gained 7 out of 8 days in a row. New York Stock Exchange net 5-day volume as a percent of the total 5-day volume was greater than 40% net upside volume. And 7-day breadth thrust was greater than nothing here is greater than 8 days. S&P 400 up 7 out of 8 days, 5-day net up volume, and 7-day breadth thrust. Concentrated action in the market to find a turning point. In this particular instance, it projects to a 36.41% gain based on its 10 historical signals. So far, it projects to 20.51%. We've gained 36.41% so far since the indicator signal. Now, this is the progression of this indicator. This shows each time in history, the S&P 400 gained in 7 out of 8 days. Can't make an indicator out of this. It takes place both in bull markets and bear markets. Even though it sounds kind of interesting, the S&P gained for 7 out of 8 days, but the reality is you see this both in bull and bear markets. This is where the S&P 400 gained in 7 8 days, and at the same time, 5-day net up volume was greater than 40%. It looks a little bit more bullish, but you still can't really build an indicator out of this, although some people would, because generally, more than 70% of the time, the market will be bullish. But we had one more thing on the same 7-day period. We want a breadth thrust of 2 to 1. Now we have an indicator, and now we have this table. The table suggests that the median return over the next 12 months, when these 3 precise things happen on the same day, will be 20.51%. We've gained 37.93%. I must point out, drawdowns, the median drawdown is only 3.11%. That's a median. There's in one instance where there's a drawdown of 13.45%, but that should not trouble you. That drawdown took place after a gain of I think it's 17%. We don't show it here. We do show it. Yes, we do show it. The market gained 30.16% from January 87 until the top in August. It then declined in a crash, which took it down 13.45% within 252 days. But the market first gained 30%. So sometimes you look at the table, not knowing the market is misleading. This is a great signal, although it shows a 13% pullback. The pullback took place after we first gained 30%. So this is an excellent indicator, and again, our clients see this all the time. Let's get another indicator. Well, let me skip there. I guess this is a good one. The S&P Equal Weight Index. Again, we have our own proprietary Equal Weight Index. It's not Bloomberg's. We equal weight on a daily basis. Deviation of dead throughout. I'll just give away the secret because it's on the next table. 6 out of 18 days. Look at the action for this index on a 6-day basis relative to an 18-day basis. We have a threshold. It crosses above the threshold, you may get a concentrated 6-day gain in this market, which is a momentum thrust. What has it done in the past? In the past, the median return was 31%. We've gained 34% to date, which is in line with the median return, slightly above it. The worst pullback you've ever gotten was a 9.27% pullback after this happened in October 2002. This is a great indicator, and it called this market movement. Indicator number 186, July 6, 2020, using the Dow. Basically, the Dow declined 9%, stopped bottoming 4 to 7 days ago, and the 5-day breadth thrust in the S&P was 2.9 to 1. This is the progression of this indicator. This shows each time the SP had a 5-day breadth thrust of 2.9 to 1. It generally is followed by bullish moves, but it did signal a week before the top in 1987. You can't use it as an indicator on its own. It did signal at the top in 2011. So you can't use the indicator alone as a 5-day breadth thrust being bullish. But if you have a 5-day breadth thrust, 4 to 7 days after a 9% decline in the Dow, this is the 5-day breadth thrust indicator, you get a buy signal. Because it's not just having a concentrated 5-day breadth thrust, that is taking place 4 to 7 days after a correction. That's what we're filtering for. Turning points take place after gains or after corrections. If you're looking for a turning point, you're looking for a correction to precede the gain. And that's why it's not data mining. It's logical to filter this indicator to be preceded by a decline. Because we're not saying the market, where there's a breadth thrust, market movements won't be random. They may be random. When there's a breadth thrust after a correction, immediately after a correction, that's when you get a bullish signal. Concentrated action, technical analysis, strictly looking at market action. I don't know how much time I have left. I think I should have a little bit of time left. So let's get to another indicator. We talked about this a little earlier. This is it. We show the progression of this one. Price indicator is September 28, 2020. S&P generated a 14-to-1 upside issue day. 3 days after, it declined 9%. Again, declined 9%, a correction. 3 days later, the SP is up 14-to-1 upside issues to downside issues, and there's no extreme in volume. The reason I'm filtering for volume is because an extreme in volume is a bullish indicator. I want to filter for not having volume being bullish to see whether the 14-to-1 upside issue day is significantly enough to generate a buy signal 3 days after a 9% decline. And it is. I didn't have to filter, I didn't have to find high volume to confirm the low. This is 5-day volume, not an extreme over the past 20 days. This is really a misleading chart. The signals are the first day it happened. We don't show the successive days. This is when the 5-day volume was not an extreme after 3 days after a 9% decline in the S&P. And this is when it's coupled with a 14-to-1 upside issue day. Now you get a buy signal. As you can see, the median return over the next 12 months, green means, the green column here tells you that each median return was greater than you'd expect on a random basis in the S&P 500. I should have mentioned this earlier. As you can see, on a random basis, any given day in the history of the S&P 500, you'd expect the S&P to show a gain of 13.76% sometime over the next 12 months. That's on random basis. Anytime you see green in my tables, you see a lot of green in my tables, mostly green, it's because the return will be greater than the random return of 13.76%. So the median return is 26.437, and each return within 12 months was greater than random. We're looking for aberrations, we're looking at extremes in technical data, and we're looking to project returns that are greater than random returns. This is a fascinating indicator. As you can see, the median drawdown after a signal is minus 0.64% in 2 days. We had a decline of minus 2.44% in 24 days, but happened to be into a Montgomery date, which is something else we'll talk about. So that was really good. Let's show another indicator. I think we have more time for a couple more indicators. I had to sum this up, but these are all fascinating indicators. Let's maybe get a little bit closer to the current time. So let's look now at an indicator in November 12th. Okay, November is a little close to this time. I'm going to skip this one. Yeah, I'm going to skip November 12th indicator, and we'll go to the 5-week weekly breadth thrust. This is a broad indicator, and here we're actually using 5 weeks of data as opposed to concentrated data. What we're looking is the weekly advanced decline line, not the daily advanced decline line. Look at the weekly advanced decline line over a 5-week basis. And at the end of 5 weeks, we want it to be above 2 to 1. weekly advanced decline on a 5-week basis above 2 to 1. This has had many signals in the past, 20 signals in the past. And the next table will show you that all these greens were when the return to the next one was above random. So of the 20 signals, 17 times it was above random. Just to give you some idea, 17 divided by 20 was telling you that 85% of the time the returns were above random, even though there were 3 instances where they were random. The median return is 18%. We've gained 13.21% so far. We're in line for another good signal. Okay, and this shows, now we're in January. We're this January 6, 2021. We're getting closer to the period we're at now. S&P 600, the S&P small cap, had a 14-to-1 upside volume day on January 6th. And at the same day, the Russell 2000 gained more than 1.7% 2 days in a row. 2 strong momentum indicators combining. S&P 600 having a 14-to-1 upside issue day, and Russell gaining 1.7% for 2 days in a row. The maximum data we're using now is 2 days. 2 days for the Russell, 1 day for the S&P 600. This happened 7 times in the past. We're showing the progression, 14-to-1 S&P 600, combined with 1.7% for 2 days. That's our indicator. The median return is 7.27%, 17.27 over within 12 months. Not once did the return over 12 months be below the random return of 13.76%. And you have to point out that there have been drawdowns were above average, 7.62% median. And this threw me off a little bit because I was really looking for that correction, which we didn't get. Our drawdown was just 0.90%. But this is the kind of things we look at to generate our returns. I think I'm gonna, since I'm getting close to the 12:30 period, we'll just get to where we are now in April. Go through January, you can see all these nice signals. This is a nice signal. Let's just do this. Let's get another one here, and let's go to a signal we had right here. April 1st. Let's look at April 1st. No, April 1st. I want to get one in March because March was an important month for the NASDAQ. The NASDAQ corrected 10% in March. March 15th. Let's get one with a more historical. March 15th. So we got March 15th, 2021. NASDAQ declined 10%. It stopped declining 4 to 7 days ago. The percentage of stocks in our broad index, we have a broad index of 1,700 stocks. Percentage of stocks in that broad index was above the 10-day moving average, was 93%. Rarely does this happen within 7 days of a decline in NASDAQ, of 10% decline in NASDAQ, do you see 93% of the stocks above the 10-day moving average. But we saw it now, we saw it in 2010, we saw it twice in 2010 and once in 2009. The median return is 24.49%. These are the signals. This is the progression. Up on lower volume. Oh, that's a different signal. This is a little bit out of order. A little bit out of order. Let's go to the next one. Oh, yeah. Oh, this is another signal. It's another signal. Okay.
And Milton, we've got a couple of questions from the audience. If
okay, let me summarize and we'll be over. You basically get the gist of what we're doing, right?
Absolutely.
I mean, we had the 130 indicator signal. I can't go through each of them. I was trying to give you exactly what we're trying to do. So let's go to the summary. First of all, I have a sell indicator. I have to hit the sell indicator. We have a sell indicator on April 8th, which is again based on VXN. You got a sell signal. This is not a very great sell signal, meaning the batting average isn't that great, but it is precisely called bear market rally tops and bull market tops 14 times in the past. These are the history of this indicator when it is successful. Basically, just as we said, when you get the first VXN deviation after 15% correction is the buy signal. We get a VXN deviation late in the cycle when people shouldn't be giving up on volatility. See, VXN declining, they're giving up on volatility. You should they're giving up on volatility after the market's up 80%. That's when you should be worried about volatility. That works as a sell signal, but it's not a high batting average. So we have to track and see. Right now, it is still filling its historical parameters when it's successful. By day 14, the market up 2.10%, and we had instances in 2010 where by day 14, the market up 2.97, yet it declined 11.84%. Our maximum drawdown was 2.21% against the previous maximum drawdown of 2.5, 4.9. So the market is still in line for a correction. Now we're going to summarize. We have 103 model-based buy signals. As you can see, our buy signals are based on precise data rather than long-term movements of the stocks. The reason we can't use long-term movements of stock is we've showed that markets change. We showed that from 1900 to 1950, the Dow is not the same as the Dow from 1950 to 2015. We showed that the S&P from 1920 to 1950 is not the same S&P as from 1950 to 2015. And we've also shown that when you want to trade based on technicals, if everyone's talking about this technical indicator, it's not going to work, because if it's obvious, obviously wrong. Review or we look at, we are currently at a speculative sell based on the VXN. A minimum projection based on our buy signal that are in line is 4723.77, which is 12% the current market. We try not to use long-term moving averages. We try not to use crossings. We try not to use breakout levels. We try not to use margin debt, cash ratios, and sentiment per se, only when it's concentrated sentiment in a short-term basis. We don't use the National Association of Investment Advisors as a trading indicator. Benjamin Graham was great at technical analysis when he used value as his technical indicator. He was not so good when he used chart patterns as technical indicators. We showed that the statistics have broken down for the Dow and the S&P. We showed the single greatest day of traded history led to the greatest rally in the history of the stock market. We showed that Montgomery cycles, which are not time cycles, the cycles in human psychology, move S&P 500, move Bitcoin, and move many other assets we don't have time to talk about. We showed that market spikes at lows, which is not a random event. On a random basis, markets will never spike. We showed that T-bond yields, when they surge, have been bullish historically rather than bearish. We show that it's important to count the days, 1, 2, 3, 4, 5, 6, 7, 8, 9, 10 days off a low, and see what happens in that 10 days rather than using 200-day moving averages. We showed how a 5-day rate of change adds value. We showed a 7-day breadth thrust, a 5-day breadth thrust. We even showed a 5-week breadth thrust when we use weekly data with its 5 points of data rather than 5 weeks of data, because we're using weekly AD lines. So it's actually only 5 points of data as opposed to 35 points of data, which would be if you use the 5 weeks. We use the days that we use days in a row, momentum streak, deviation from trend thrust. These are the kind of things you look at, which is not obvious, which most technicians don't talk about on a daily basis. Having said all this, I believe that technical analysis still is in its infancy. There's a lot to learn. I'm learning a lot every day. I actually learned a lot from the 2 previous speakers. And this is a profession which has a long life ahead of it. Value investing has proven to fail because fundamental value investments began failing in the 1960s. And now with growth outperforming value, people are looking to return back to the median or it doesn't work that way. Markets change. And markets change in ways that if you just stick to whatever you've seen in the past, it's just not going to work. And I'm glad I'm a technician because I'm a CFA. I started as a straight fundamentalist, and that hasn't worked. But maybe being a technician will allow me to have better market calls than I would have had if I was strictly using fundamental analysis. Thank you so much for your time. I appreciate this opportunity.
Milton, that was fantastic, and I know many of our audience are familiar with your work. But before we close out your slides, I know we've got a number of questions from the audience that we'd love to get to. And for those who don't get their question answered right now, that contact information is right on screen to get a hold of Milton and pick his brain a little bit more. There's a lot in there that we could discuss, and I want to touch on 2 things very quickly. First, quick and easy, the work of the illustrious Paul McRae Montgomery is definitely outlasting Paul and will be with us for a very long time. But is there any written work that you would recommend? Many of us are familiar with his Time magazine cover, contrarian indicators around media sentiment and other cycles of human behavior. Any place that you would recommend people to check out to learn more about Paul's work?
Well, I have copies of all Paul's speeches. I could forward it to anyone who would like to see it, because that'll be very helpful.
Yes.
But he didn't publish any books. He should have. He never wrote any books. But he wrote amazing reports and he had amazing speeches. And I have copies of all his reports going back to the mid-'80s, from mid-'80s until he passed away in a few years ago. And I also have copies of the speeches he gave, and I could forward to anybody. I would say that Paul had some secrets that he didn't disclose. For each cycle each 2 cycles Paul gave me, I have 6 cycles that I give to my clients, because Paul did not disclose either side of the cycle. There are more cycles, so we use more cycles than Paul would disclose to his clients. But in his trading, he did use the cycles that I talk about. Very good,
very good. And now if we can dive in just a little bit to the statistics side. I know folks really appreciated the presentation. We had a couple of questions just around the low frequency of the signals that were being generated. So if you could speak a little bit, not about all of the inputs to the signals, but about your comfort level with the statistics, and maybe philosophically how you approach avoiding things like curve fitting and other pitfalls within the statistics.
Right. That's an excellent question.
Good afternoon. My name is Joel Panikot and I run the CMT Association's operations in Mumbai. I trust you've enjoyed the first session of our 2021 America Summit as much as we've enjoyed bringing it to you. In a pre-pandemic world at a conference like this, we would have made the best of these breaks between sessions by stepping out into designated spaces for networking, meeting new, like-minded people, and sharing our thoughts and insights, teaching some, learning some more. Some of my best professional relationships have come from such networking opportunities. At the America Summit as well, we have created a space for networking, albeit virtually. I encourage you to take a moment to visit our networking zone. My colleague and our Director for Marketing, Emily Meyer, will show you how.
To network and connect with attendees, we recommend that you first complete your profile. To complete your profile, you'll navigate the bottom navigation bar and click Profile. From there, you'll see your name in the top corner. If you click that, where it says Emily Meyer for me, will bring you to your profile page. To update your profile, you click Edit in the top corner, and it will bring you to your individual profile page where you can upload an image and import your information via social media. You can also import your information manually by completing the fields below. Once you've updated this information, make sure to click Done so that it is saved. To find other attendees, navigate back to the More button in the bottom navigation menu. From there, you'll be taken to this page where you can click Attendees. You'll be able to see the full list of attendees in the Attendee section. When you click an individual, you have the opportunity to make a note or send a message within the app. You also can share your contact information with an attendee by clicking Add Contact, or you can schedule a meeting with the individual. Just a note, the meeting function adds the meeting to your personal agenda in the CMT Americas app, and it is not connected to third-party calendars like Outlook, Google, or iCal. So if I click to add a meeting with Mariana, do title, I'm going to do a test, and we'll set it for tomorrow at 8 a.m. We can click Reminder. And you click Create, and that sends the invitation. Now let's go back to my schedule, and you'll see that at 8 a.m., your meeting has been set with Mariana in your personal agenda, or whomever you choose to connect with. You can also access your messages under the Profile section in the bottom navigation bar. Here, you'll see the list of messages that you send back and forth with attendees. You can access the appointments that you've received from other attendees. This is where your contact information will be shared when you add contacts. And that's it. To network and connect with attendees, we recommend that you first complete your profile. To do this, you'll click your name in the top corner and click the Edit Profile link. From there, we recommend that you toggle your profile to visible so that you remain visible to all attendees in the event guide. You can import your details using LinkedIn, Twitter, or Facebook, or you can manually update your information by filling in the fields below. Once you've made the changes, don't forget to click Save. Once you've updated your profile, you can click the Attendees button, and you'll be able to find a list of all registered attendees for the CMT America Summit. If you click in to a person's profile, you'll be able to take notes, send a message within the app, share your contact information with that attendee, and schedule a meeting. Please note that you're scheduling a meeting in the digital event guide. It does not host third-party calendars like iCalendar, Google Calendars, or Outlook. To find information about who is contacting you or whether you have been contacted, you'll click the My Items button in the left navigation bar. From there, you'll be able to see your messages, which will pop up in the corner. You can schedule appointments or view appointments that have been set for you with you. You can find contacts that you've already connected with. You can view your notes, and you can also view your bookmarks. We hope you use the digital event guide to foster new connections in the technical analysis community. Enjoy the CMT America Summit.